Welcome back to this special Indianomics where we are discussing whether India's banking model has been challenged and is looking like changing and becoming tougher. I've been speaking with Mr. Dinesh Khara, Mr. S.S. Mundra and Srini Varadarajan. Gentlemen, thank you very much for your patience for staying on. My next question is, what can the regulator or what should the regulator do? Mr. Khara, the EBLR, External Benchmark Lending Rate Rule, the Reserve Bank brought it because banks were not passing on the rate cut even after RBI announced a rate cut. So they said your lending rate, many of them, will be linked to the repo rate or the T-bill rate. But the cost of funds, the deposits are not linked to anything. Do you think EBLR needs to be refined? Do, say, savings deposit be linked also to repo, something like that?
No, actually, Lata, there was a situation where there was an effort made by banks to link the deposit rates with the external benchmark. But what we have seen that, the market does not respond to that. And normally it doesn't really work out well. So that is the reason why perhaps, and also we have to acknowledge the fact that when it comes to savers, that community is very broad-based. There are very common men who may not like to have that kind of a risk sitting in their deposit book. So I really wonder whether it will be a success or not.
Okay.
But I think what you mentioned, when it was introduced that, you have to link up your loan book to the EBLR, then perhaps, that can be revisited maybe.
Exactly. That was going to be my question. Srini, do you think, therefore, loan book could EBLR be rejigged? Because it seems to impact only one side.
I don't think so. I'm not understanding why that should be the case. I think EBLR is now reasonably well established. Okay. I think it to some extent improves transmission. See, the whole thing on the liability. See, I think the liability side starts first. I think the license to grow for a bank comes from its ability to raise deposits in a sustained, robust manner. And I think that should be the fundamental principle behind growth in any bank. If you try and grow the asset side at a pace which is much faster than what your sustainable deposit growth is, there is always going to be a problem. And therefore, banks have to calibrate their growth on the asset side based on how their deposit profile is growing. Okay. If you try and grow assets and then try and search for deposits, you will end up sort of weakening your liability profile. And that to a large extent is what we are seeing in some of the smaller banks. So the thing is, I don't see any reason to tinker with the EBLR. I think what we need to do is to try and make sure that the liability side growth to a large extent drives the pace of asset growth. And as long as that is there, I think it will work. Okay. By growing the asset side faster is when I think the risk lower NIM sort of increases substantially.
Okay. Well, there are some banks, of course, with very stable deposits, salary accounts like Mr. Khara's bank. And so they can have the ambitions of high growth. But
that's what I said, Lata. Yeah. There are few banks which are on an incremental basis taking away the lion's share of CASA as well as retail term deposits because of their ability in terms of digital engagement and various other things they have in place in terms of customer profile. Okay. With the result that every other bank becomes a price taker and therefore they are in a very difficult situation.
Well, Mr. Mundra, I want to come to you because you brought the very important point that banks have to churn their assets now. You can't give the loan and hold it till maturity. You have to manage the book. Do you think the regulator also has to become a little open to banks depending on wholesale funds and managing the liability part also? The fixation with CD ratio probably, as it is, in the D of the deposits, they are not including NABARD refinancing and, the D is a little underestimated. So do you think separately, the RBI also has to become a little open to people taking bulk deposits and certificates of deposits? Nothing wrong. We have all to become marketized.
Okay. Number one, I think whenever there is a little sign of stress and the narration goes back that then our regulators should do something. Okay. I think all the entities are mature enough. Market processes are well established. To my mind, one, I have already mentioned that you have to manage your credit book more efficiently you have also to become more efficient in your asset liability management. Now, if you look at it, I mean to say, you see there is something like behavioral pattern in CASA deposit, which is allowed by the regulator, right, for your ALM plotting. Now, if you look at the behavioral pattern of your CASA deposit, you also look at the behavioral pattern of your wholesale deposit, you reach to a core portion of your deposit, which you can call as a core portion. You put some allowance there also further, little bit as a cushion. That core portion is what you should use for your long-term lending. Match it. And then you have the short-term lending and the consumer loan. And that long-term book also which you create, then you should be able to churn. I think it will be a virtuous cycle. But what I am trying to say, I agree with all the gentlemen, with you, the whole structure, it has to go a structural shift. Now, there has been argument that this preemption should be reduced or other the regulatory cost should be reduced. Okay, fine. To my mind, that is not a lasting solution. That is a band-aid. Regulator do it today. Within 6 months or a year, everything will be absorbed and you are back to the same place where you are. So I think what we should look at is the more lasting and root cause solution rather than every time clamoring for that, regulator should come with some crutches and provide the help.
Okay, I want to quickly try and get two questions. Mr. Khara, does the government have to rethink taxes? I mean, debt is really getting a bad deal compared to equity. And the corporates also need debt capital. They can't only manage with equity. Is there a rethink needed?
Well, I think when particularly in the context of the deposits also, there is a scope, because when it comes to deposits, it is subject to tax on accrual basis, whereas when it comes to capital gains, it is subject to tax on the cash basis.
Yes.
So I think that is one area which probably needs to be addressed. And what you mentioned that, when it comes to even the long-term capital gains also, for a economy which is aspiring to grow at much faster pace, we would certainly need the debt as well as the equity both. So the gap between the capital gains probably it needs to be re-looked into. So I think there is a scope which can perhaps be looked into depending upon the fiscal room which is available, can perhaps be looked into.
Yeah, I guess there are a lot of votaries for low capital gains on equity. Capital gains tax on equity, but there are not so many people supporting debt. Final question to you, Srini. The usual cry is when animal spirits are there, loan growth will come. After all, every loan creates its own deposit. Therefore, this argument is only because you are under pressure, you're bringing all these arguments. Once the animal spirits come, deposits and loans will both grow. Is that a good argument?
So I agree. I think the growth drives credit rather than credit driving growth. So the whole thing of trying to say, give more liquidity and credit growth will happen and therefore growth will have an uptick. I don't agree with that. I think growth, when it happens and animal spirits are there, automatically credit will be driven up. Never have we seen banks short of money when there is demand. Just by having liquidity and money and trying to push credit, I don't think so we'll achieve growth. So it has to be that investment happens, growth comes back, animal spirits are back, automatically credit will grow and banks will be finding the deposits in whatever form.
Okay, fair point. Let's end on that optimistic note. Thank you very much, Srini, Dinesh Khara and Mr. Mundra. Very important takeaways. One, growth actually solves a lot of problems. We crib when growth is not that good. Second, there's no denying that margins are under pressure. It's not going to be as easy as it was when FDs were the way in which people saved. Third, banks will have to get more active in the way they manage their asset book, and perhaps the regulator will have to get a little more tolerant with respect to banks relying on wholesale funds. And finally, does the government have to rethink on this very big gap between capital gains tax on debt and on equity? Thank you very much, gentlemen, for a very interesting conversation.
Thank you.
Thank you. Thank you, Lata.